Good morning, ladies and gentlemen. Well, almost nothing happened last week, so I just want to give you one high level point. I've been consistently saying for the past, I don't know, close to 2 months, that the window of weakness would be in the second half of May until the end of June. And we are now in that weakness window, that potential weakness window. And for the first time on Thursday, we got weekly claims which were slightly weaker than the market expected. So, right on time. NFP this week is going to be absolutely crucial because this is the first NFP which could actually show some real weakness in the economy. And also, if it's not this one, then it has to be next month's. That is about as much as the data will allow for this window of weakness to open. And if we do get this window of weakness, then the Fed has to ease. It has no choice, and it won't ease by 25, it has to ease by 50 plus, because they've told us they know that if weakness develops in the economy, then we are behind the curve, and we're behind the curve by a lot, and we have to ease a lot. So, only two alternatives here. Either the weakness is real and we will know by Friday, because we get the weekly claims on Thursday again, and if they're weak again, that increases the odds that NFP is going to be weak. And that is why I keep on saying this week, and just like the last few days of last week, you cannot be short of bonds, because if the move happens, it's going to be very, very fast. So if you look at 2s, 10s, absolutely nothing happened. But what is happening is that the 2s, 5s, 30s and the 2s, 5s, 10s butterfly is going out. So this is the 2s, 5s, 30s butterfly, and it's making new highs for the move. What does that mean? It means that people are parking their money not in 2s at the moment, because 2s don't have enough duration, but they're parking their money in 5s, and they're ignoring 30s. What will the yield curve do if, or rather, what will the shifts be if there is this window of weakness? If the data starts now turning weak for employment, then it's going to be the 2s, 5s which moves, because people will start going even shorter, thinking that the Fed will now start cutting by 50s, which is what they've said. That should be no surprise to us. So I keep on now watching the 2s, 5s. If we start failing here and on Thursday and Friday we get weak data, 2s, 5s is going to go and make new lows. So let's have a look at each individual tenure. And as you can see, the 2s just cannot go above 406. Everybody is prepared, or rather nobody wants to give up the possibility that the Fed will start easing, and easing quickly soon. If the data is weak, we go straight down to 368 and even retest these lows around the 355 area. 2s will be a big mover on the weakness, on potential weakness on Thursday and Friday. The 2s, 5s will then go positive, and by more than these 6 basis points, 390, 396, it'll go positive 15 or something like that. And the whole curve is going to steepen by a lot. So 2s, 30s is going to go and make new lows. And if we have a look at where the first target is, the first target is 143. So that is what is going to happen if you get the window of weakness truly open. And why? Well, because the deficit will actually explode if we start going into a recession and the Fed has to cut. Everybody will move all the money they've got now in fives. And why in fives? I don't know if I told you, fives have some duration, and therefore that is where people like to park their money when they're uncertain. But as soon as they're certain, they'll move it out of fives into twos, and we'll go all the way down to 143 on this 2s 30 spread. And even the 2s 5s, as I told you, it's going to go all the way back down to 27 in a hurry. Now, what is going to happen if there is no weakness, if the non-farm payroll is actually strong, and if the weekly claims on Thursday are not weak, and they show that last week was an aberration? Well, I think we get some modest flattening, because the 10s and 30s have, a decent amount of pickup versus general collateral. It makes sense that the places that people have been parking money in and anticipating a Fed cut and this weakness actually give up some. So twos are going to go back to 406. I don't think they go much higher. Fives could actually go all the way back up into the 420s without any problem on strong data. I don't think the 30s and the 10s and 30s are going to be too much affected. In fact, they're going to be affected less. So I'm saying there's going to be a modest flattening. The 10s will go back up to, this 458, and they'll be quite happy there. The 30s, I think they'll trade up to 505, something like that, and remain at those kinds of levels. The real yield pickup is decent. We have a real yield of 206 in 10s and something like 264 in 30s. So it's not a bad real yield pickup. If the data is not weak, it has to be the 2s and the 5s especially which get hit, because there's really no juice there. You're funding it negatively, and it just is very unattractive. While the 2s will not go much higher than that 406, the 5s might go a little bit more. So it's got to be a very gentle flattener, because at the long end, I think for quite a while, you're not going to see a lot of movement. We, of course, have the ECB on Thursday as well, and the cut is almost guaranteed, but this should be the last cut for a while, which means that the 2s are really not going to go a mile from where we are now. In fact, I'd expect them to remain in this 190 to 170 range. But what should change is then that people start moving money out of Germany and Europe in particular and go into the US. That would make sense, because if there's going to be any weakness in data in the US, and the ECB has actually signaled that they are at or very, very close to terminal, then that money should really go out and pick up some yield, because that is the only thing that makes sense, right? So they will actually, inside Europe, they should buy some French paper and Italian paper as opposed to German paper. And what would make some sense to me is if the German to French spread actually started coming back in towards the gap that we had at the beginning when the panic started. As you can see, it's traded in this 15 basis point range, but it would make sense to me that they start preferring the yield of France because of the extra pickup. I really, really dislike bunds. I think that they are the 10-year that yields the least and has the least real yield. I really don't understand why people would want to hold it when they could, hold Italy, or they could hold France. And especially, Italy's come a long, long way. So I really wouldn't be looking to buy that compared to Germany. But France, some modest move in towards 62, or even to these levels, 57, 58, would not really surprise me, because once the ECB is done, what are you going to do? I mean, you either transfer into the US, or you go for the higher yielding paper inside of the EU. So this is the Schatz against the 2-year note. And if the ECB is done and then you get weak data in NFP and weekly claims and all, this spread comes straight down to 193. It's going to be fast and furious, and then it's going to go to 180. It's the only thing that makes sense, because the ECB will probably say, in not so many words, but between the lines, that they are done for a considerable period of time. And then you get weak data in the US, if you get it naturally. What is going to happen? Well, everybody is going to pile out of something that yields you nothing, like the Schatz, into something that they are speculating is going to get a 50 basis point cut by the Fed, not naturally in June, but at the next meeting. So that spread should move at least 20 to 30 basis points very, very quickly. And that is the one I'll be watching next week with an eagle eye, because if it moves, it's going to be one of these moves. It's going to go to at least 180. And naturally, if this window of weakness opens, the big mover is going to be in the SOFAs, the 25 to 26 spreads. This is ZZ, and it's going to go all the way up here. It's going to go positive. I have no doubt that it goes positive as soon as there is weakness, because the Fed will be cutting this year, not next year, and it will be cutting by 50s. So my view, it's going to go initially all the way up to minus 29 very quickly if it's confirmed. So you get a double whammy. You get another piece of data which is weak. It goes straight to the 200-day moving average, and then it goes positive. Because, as I've told you before, as soon as there is weakness, the speculation will be 50s cuts by the Fed at the next meeting. And it's all going to be the very short end that moves. The dollar has been doing exactly what I thought it would do. It's consolidating nicely, waiting for this window of weakness to open. And if it's realized, and it could very well be realized next week, who the hell knows, the data will tell us. My first objective is going to be here. It's going to be 96.50. That is going to be the objective. And if we have a look at the euro, what does that tell you? It tells you that it will be the start of the next move, which takes us to 118 to 118.50. This kind of level, and that could actually be the top, right? But we just need to see the end of the ECB cuts, and we need to see the opening of the weakness window for real, i.e. weak employment data. If we see those, then the next leg of the dollar debacle starts happening. And I don't think that the administration in the US will be in the least bit sorry to see it happen. It'll be a very violent move, just like the move between the Schatz and the 2-year note. just like the move between SOFA Z5, Z6, because all those relationships will change. And all those relationships changing is very bearish for the dollar, and you get these moves. Now, will it happen? Will we get the weak data? I don't know. I'm just saying that if that happens, that is the kind of thing that you're looking for. If it does not happen, you're looking for a continuation of this, sideways trading, and eventually, if it does not happen by, say, the end of June, then you're looking probably for a retracement in the dollar all the way back down to 108, these kinds of levels, because there'll be no reason really to start looking for a weaker dollar. The dollar is going to remain pretty strong if their economy is doing great and they have a differential against the euro, over 200 basis points. It's going to be very difficult for the dollar to weaken substantially. If that differential comes in, because it has to come in because of the difference in the economic cycle and the interest rate cycle, then you can easily see this 118.5 level. GSG actually gave up some ground last week. It was quite weak, as was gold. So let's try to piece this together. If I was sitting at the Fed and I looked at this chart of GSG and I looked at gold and I looked at bonds, I would be saying the following. The likelihood of inflation accelerating here is very low. If we get weak data, we should cut. And if we don't cut now in the June meeting, which I don't think they will, then we should definitely consider cutting. If this chart remains the same, with GSG going sideways as it has done since basically 2022, and not giving up, sort of not trying to break up above 22.93, which it won't do if the economy is weak. In fact, it'll be trying these levels. Why not cut? That is the only thing that makes sense to me, and why not cut by at least 50 basis points to relieve the pressure on employment? There's very little likelihood that they consider tariffs as anything but transitory inflation, and if commodities are telling them really that there is no price pressure on the industrial sector, why would they not cut, and cut by quite a bit? I definitely think the Fed will do it, to relieve political pressure, because they are subject to political pressure, let's not kid ourselves, but also because it makes sense. We saw what the PCE was, we saw CPI and PPI. They're not accelerating, they're not coming down to the target as fast as the Fed would like, but they're definitely not accelerating. And there isn't a single price indicator, forward-looking price indicator, determined by free markets, that is telling them that there's any likelihood that inflation will accelerate. Real yields are middling, okay? As I said before, they're neither, table pounding great, nor are they awful. So they have slack. They have room to ease if they want to. And that's why I keep on saying that at this very moment, you just cannot be short of bonds. And probably you can't really be long of commodities either. If it comes into this window of opportunity, I think 1977 would be a great level for a bounce, because I think at these kind of levels, Fed cuts are almost guaranteed to happen. I know there is no direct relationship between commodity pricing and the Fed, but I think that if they see this kind of level in commodities, they will have every justification that they need to cut. Gold, it's so difficult because it just makes very big moves on nothing, and then it just goes sideways. But the logic of a weaker economy if it happens, and a steeper curve at lower levels in the US, and a narrowing of spreads if it were to happen because the Fed starts cutting, should be bullish for gold, or certainly not bearish. Real yields will come down, and therefore, another competitor for gold bites the dust, as it were. So where are the levels that one can give it a go next week? Well, certainly if the economy starts weakening, you should start seeing it close above 33.47 and test this 34.29 level, which is the all-time high close. If not, I think it remains in a range. I think the pressure on gold is unlikely to be that huge unless the dollar starts strengthening. And if the dollar starts strengthening, then I can see it come down to these kind of level, 3136, sorry. That I can definitely see, and I can just see it come a little bit lower against GSG and do some kind of an ABC and come down towards 1280. So I really don't know what to tell you about gold. I've been wrong for such a long time that I even hate looking at it. But at some stage, I'm looking at gold to GSG to give me a signal when to get into GSG, because it really doesn't make sense for gold to be so elevated and GSG to be so low. At some stage, I want to switch into GSG, and I'm hoping to see this kind of ABC to allow me to do that. Bitcoin failed to close above the all-important 106,235, and I think that it retested a couple of times, but does stop people out below 100,000, and then it's probably ready to go up again. Why do I think that? Because I keep on looking at this chart, which is MSTR over 1.5 times Bitcoin, or 1.5 times EBIT, makes no difference. And we are on support, and that's where I sold it, that's where I bought it back. We are just going sideways here for a bit, and every time that MSTR now, it should start outperforming a little bit. EBIT or BTC, same thing. You get a bit of pressure on the BTC side of things, simply because people who were short of MSTR and long of BTC are reversing their positions. So they're buying MSTR and they're selling their Bitcoin. And that gives Bitcoin some pressure, and it tends to move sideways, if not down. So it all depends. If MSTR now starts going up, then Bitcoin will go up less, i.e. that it'll be more or less stuck. But I don't think MSTR itself is going to go up too hard. It's going to remain sideways, and I think until it's reached 341, it's not really ready for the next bull phase. And if MSTI is going to go sideways, and I'm a big seller of calls up here, then what you have to expect is continued sideways to slight weakness that stops people out in BTC. And I really would not be surprised to see dumps down to these levels around 96, 98, where I think you can start the next accumulation phase. So let's have a look at the clean chart and see what the market is doing, because this is going to tell us the easiest way. So Trump rescinds his tariffs. We go up above 58.65. We remain in a range. We go up to 6,000, which we can't see on this chart because then we had the 830 weekly claims, which was slightly weaker, and we come back down to 58.65, stop everyone out, but remain in the range. If now we get a second confirmation of that weakness, we definitely go down and fill this gap all the way down to 57.62. I have very little doubt about that. And then I think that we break and we fill these gaps down to 56.68. It's basically going to be binary here. If there is weakness, I think there's going to be a lot of movement out of equities into bonds, and the dollar will weaken, and that will take some pressure off the equities. But I think this kind of level is almost guaranteed, 56.68, for the if we get weakness in non-farm payroll and weekly claims. That is what I would expect, some kind of an ABC down, at least down to this kind of level. If there is no weakness, I think it's a continuation of the trade and we get 6,000 without any problems, and then probably 60.90 to 61.18. I think that is going to be our ranges and our range of outcomes. I prefer the downside because I think there is more odds that the data is weak and that everyone starts betting on big rate cuts. But equities, while being supported by these rate cuts, what they don't like is rate cuts because the economy is weak. What they do like is adjustment rate cuts, but I don't think that that will be the reason why they cut. If they cut, they will only cut because the economy is so weak. And then all this whole range is going to be reflected to the downside. We close the monthly candle and NQ managed to stay below this 21,478, which was the previous monthly close, high close. And it looks to me like it's going to remain in this range, 20,600, with, the low being there. If there is additional weakness, I can only see it going down to 19,900, and that is probably all she wrote, or even 20,400. I am a definite better buyer of these, of NQ over SPY. And I think that the sectors that make sense buying are the ones with high tech, are the ones with defense, and the ones with industrials. That is what they want to strengthen. That is what the current budget allocates to. And I really can't see that those sectors overall will not continue to do better than the SPY. So let's have a look at that. XLI is one of the only sectors which has returned to all-time highs. And if one has a look at SPY over XLI, one can see that it's definitely outperforming this year. It's, up quite a bit. It might go sideways, but I think it's going to break during the course of the year, this 406, and go all the way down to these levels, 390s. To me, XLI is a sector that you want to continue buying. And ITA is the other sector that made new all-time highs and just doesn't want to stop. And if one looks at, ITA, SPY over ITA, it has really broken these levels and it's on its way back down to where it was in 2018 and 2019. I think it's going to be a continuation of that move. Those are the sectors that I prefer and I think fundamentally make sense because that is where the money is being allocated to by the administration, and that is what they want to support. And whatever defense sector you look at, whether it's XAR or whether it's ITA, it's the same picture. It's going up. the allocation of money does not lie, to me, XAR or ETA and XLI over SPY and XLK over SPY are the allocations that you have to have, or you go and look to buy dips, because that is going to be the continuation trade for the rest of the year. EEM might be the canary in the coal mine next week, and I'll just enlarge this chart for you. I think if next week it starts trading below 45.04, it's likely to trade all the way down to the 43s and look to bounce off this 42.25. That will lead the US lower, and I think at these levels you buy EEM for a big move up. So that is going to be my canary in the coal mine next week. If that starts breaking 45.04, I will have a better feeling about trying to short SPY on any bounce. So for next week, the big data is going to be Thursday and Friday. I'm looking to see if the ECB says between the lines that this is it, we've stopped cutting. And then if you get weakness from non-farm payrolls on Friday and on Thursday weekly claims for a second time, I think this window of weakness will be opening up, and certainly the market will be speculating that it's opening up, in which case I think that the yield curve steepens a lot. I think the spreads in SOFR move a lot, and the dollar probably starts another leg lower, as I explained earlier, and those are the things that we'll be looking for next week. Thank you very much indeed, and tweet you tomorrow.